Have you ever felt like the market is rigged? You place a trade, everything looks perfect, and then suddenly, the price moves against you, hits your stop loss, and then immediately reverses back in the direction you predicted. It's frustrating, right? It almost feels like someone is watching you, deliberately targeting your trades. Well, you're not entirely wrong. Today, we're diving deep into who really controls the market, and I promise, by the end of this video, you'll see the charts in a completely new light. So, who's pulling the strings? To understand this, we need to talk about the smart money concept. The market is essentially a battleground between two types of players: retail traders and institutional traders. Retail traders are people like you and my, individual investors, trading with our own, relatively small, capital. We use common technical analysis tools, follow popular strategies, and our collective actions, while significant, are often disorganized. On the other side, we have the institutional traders, often called smart money. These are the big players: major banks, hedge funds, and large financial institutions. They trade with billions, even trillions of dollars. Their sheer size means they can't just click buy or sell like we do. A massive order would instantly move the price against them before they could get their full position filled. So, they have to be clever. They need to accumulate their positions discreetly, often in areas where retail traders are placing their stop losses. This brings us to the concept of market makers. In essence, these are entities, often large banks, whose job is to provide liquidity in the market. Liquidity just means the ability to buy or sell an asset easily, without causing a major price fluctuation. To do their job, market makers need to manage their own risk. They see the order book, they know where the buy orders, sell orders, and importantly, where the stop-loss orders are clustered. These clusters of orders create what we call liquidity zones. Think about it from a retail trader's perspective. Where do you typically place your stop-loss? Usually, it's just below a recent swing low for a long position, or just above a recent swing high for a short position. It's logical, right? It's what all the textbooks teach. And because millions of traders are taught the same thing, huge pools of stop-loss orders build up in these very predictable areas. For the smart money, these pools of stop-losses are like a treasure map. They represent a massive source of liquidity. This is where the infamous stop hunt comes into play. A stop hunt, also known as a liquidity grab, is a deliberate move engineered by smart money to trigger these clusters of stop-loss orders. Let's walk through a simple example. Imagine the price is in an uptrend, and it has just formed a clear support level. Many retail traders will go long, placing their buy orders near this support. And where do they put their stop losses? You guessed it, just below that support level. Now, a large institution wants to buy a huge amount of an asset, but they need sellers to fill their orders. Where can they find a ton of willing sellers all at once? The stop-loss orders. A stop-loss on a buy position is a sell order. So, the institution will intentionally push the price down, just enough to break through that support level. As the price dips below support, it triggers a cascade of stop-loss orders. All those retail traders who are long are now forced to sell at a loss. This sudden surge of selling pressure provides the perfect opportunity for the smart money to sweep in and fill their massive buy orders at a cheaper price. Once they've accumulated their position, what happens next? The price magically reverses and shoots up, leaving all the stopped-out retail traders behind, scratching their heads. It looks like a V-shaped recovery on the chart, and it's a classic footprint of a stop hunt. The same thing happens in reverse for short positions. If there's a clear resistance level, many retail traders will go short, placing their stop losses just above it. Smart money, wanting to sell a large position, will push the price up to trigger those buy stops. This provides them the liquidity they need to enter their short positions at a favorable price before driving the market down. So, is this manipulation? In a way, yes. But it's also just how the market works. The big players are not doing anything illegal. They are simply using their capital and knowledge of market structure to their advantage. They are hunting for liquidity where it is most predictable. The key takeaway here is that they are not targeting you personally. They are targeting predictable patterns of behavior exhibited by the retail crowd as a whole. This might sound disheartening, but it's actually incredibly empowering. Once you understand the game, you can start to change how you play it. Instead of being the liquidity, you can learn to trade alongside the smart money. The first step is to stop thinking like a typical retail trader. Stop placing your stops in the most obvious places. Start looking at the charts and asking, where is the liquidity? Where would the majority of traders place their stops? Where is the market likely to go to grab that liquidity before its real move? Look for signs of these liquidity grabs. A common pattern is a false breakout. The price breaks a key level, tricking traders into thinking a new trend is starting, only to quickly reverse. This reversal is often the true entry signal. The smart money has taken out the stops and is now ready to move the market. You can learn to identify these institutional footprints, like order blocks, which are specific price candles where big players likely place their orders during a stop hunt. When you see price rapidly sweep a clear high or low and then strongly reverse, that's a huge clue. That's not random noise. That's purposeful action. That's the smart money revealing its hand. By understanding these concepts, you shift your perspective from being a victim of the market to a student of its mechanics. You start to see these stop hunts not as frustrating losses, but as opportunities. So, to answer our original question, who controls the market? It's the institutions, the smart money. They're not evil geniuses. They are simply playing the game on a different level, a level that requires them to seek out liquidity. And that liquidity, more often than not, comes from the predictable behavior of retail traders. The good news is that you don't need billions of dollars to succeed. You just need to understand the framework. Learn to identify liquidity zones. Be patient and wait for the stop hunt to happen. Then, look for confirmation that the smart money has entered and trade in the direction of their intended move. You're essentially hitching a ride on their massive wave of capital. This is a fundamental shift in trading philosophy, and it won't happen overnight. It requires practice, patience, and a new way of looking at price action. But once it clicks, you'll never see the markets the same way again. You'll stop being the fish and start thinking like the shark. I hope this has been a real eye-opener for you. If you found this explanation of smart money and stop hunts helpful, make sure to hit that like button and subscribe to the channel. We'll be diving even deeper into these concepts in future videos, breaking down exactly how to spot these moves and how to build a strategy around them. Drop a comment below and let me know if you've ever felt the sting of a stop hunt. Thanks for watching, and I'll see you in the next one.